My name is Micah DiSalvo. I have the opportunity of leading our sales organization on the qualified business for Newport Group, and we are thrilled to have such great turnout today in hosting our quarterly thought leadership series here at Newport Group. I had just shy of 200 advisors register for this webcast, and people are dialing in as we speak, so welcome to the team. So the title of the presentation today, like our moderator said, is Boost Your Business Offering with a Bundled Non-Qualified Deferred Comp Solution. And what I thought I'd do is the setup to this conversation, share a little bit of context to how we got here, and most importantly, what we're putting forth to advisors in the marketplace. And historically, Newport Group has been a dominant leader in the non-qualified space, but again, historically, very upmarket. And so when you think about the demographic of the advisor community that specializes in non-qualified deferred compensation arrangements, that demographic is not growing. And so being a leader in the marketplace, we also have a responsibility to help educate the advisor community and ultimately the clients that we all serve. Alongside that, when you think in terms of our qualified business here at Newport Group, we've been historically a leader in, call it the small market, mid, and large. And depending on the opportunity, in the 1 to 20 space, Newport Group has just a significant amount of volume in terms of new opportunities and new plans that we win every year. But then over 20 million, where there's a specialty involved, we compete extremely well and we win our unfair share of the business. Today, Newport Group is positioned as the largest independent advisor sold record keeper in the industry. And we're really proud about our independence, really aligning ourselves on the same side of the table as advisors, plan sponsors, and ultimately the participants that we serve, because we don't have a product that you manufacture. It's all open architecture, and again, 100% of what we do is core to record keeping and retirement plan administration. And so, this year we'll do about 800 new plans in our core markets, but historically that hasn't lined up with our non-qualified business, which again has been historically very institutional, very upmarket, and a solution that has been fairly sophisticated. And so what we'd like to do, and with giving that context, is help educate the advisor community on the tremendous opportunity that we believe in a bundled solution, bringing in together both a qualified plan solution along with a non-qualified solution. And that's really what we're here today, is to help educate everyone on the call around the opportunities that are in the marketplace, what we can do to help educate all of you, and then ultimately together, how can we win business and participate in a meaningful way in a strategic relationship. And so with that, I thought I'd open it up for a quick poll. And this is the interactive part of the session. It's always hard when you have hundreds of people on the phone and you open up the line. It's impossible to have an open dialogue. But with interesting technology, we are going to ask all of you to ask this or answer this question, if you please. On your screen, select one of these. So the question is, does your practice currently include offering non-qualified plans? And there's 4 options there. And so if we could take a couple of minutes and enter the answer here, we're going to have, just in a minute, Tony tabulate the results here and show them on the screen for a minute. And what we'd like to do is just really get a gauge of, roughly just shy of a couple hundred people registered for this conference, and a significant amount of people on the line. How many people have this in their business today, and most importantly, who are interested in it going forward? So, Tony, if we could tabulate the results here. All right, so that's what I thought. So about, call it a third of the audience today says yes, but only a handful of plans. About 70%, just shy of 70%, says no, but I'm here to learn. And that's really what this webcast series is all about, and what we can do to help provide thought leadership to the marketplace. And I think what you'll find with the agenda in two of our senior executives from our non-qualified plan business, both Jeff Wirth and Mike Shannon, are here with me today, who have dedicated their life's work to the non-qualified space. And so I think from a knowledge standpoint, second to none in the business, and that's part of what you will find in working with any of our 1,000 employees here at Newport Group, is that we hire, retain, and promote some of the industry's top talent. And so over the course of the next 45 minutes plus, what we're going to talk about, starting with the agenda slide, is number one, non-qualified deferred comp 101. What's this business all about, and how can you participate and compete in a meaningful way? And then share with you a little bit about why we're so excited today to roll out officially to the marketplace Newport Group's bundled non-qualified solution. So from a plan design perspective, pricing, how that works, administrative services, and again, ending with the opportunity for all of you. And then we'll open it up for questions at the end. So please think about what questions you'd like answered by our speakers today. And you can enter in the questions in the chat section, and we'll be reading those towards the end so that we can continue to have a dialogue back and forth. So with that, I'd like to turn the call over to Jeff Wirth, who is our Senior Vice President in charge of our non-qualified plans here at Newport Group. Jeff, the floor is all yours.
Thank you, Micah, and thank you to all who have joined this call today. As Micah said, we're very excited to continue our commitment to the retirement plan business and to expand our offering with a product that offers your clients a best-in-class product for both their qualified plans as well as their non-qualified plans, and we think is a great solution for you to continue to grow and retain your book of business. On page 7, we're going to start out by asking the question, why should deferred compensation, why should you offer it? So from an employee perspective, a deferred compensation plan allows the employee to have more options, so to manage what their retirement objectives might be. It also, similar to a 401k plan, is done with pre-tax deferrals. Unlike a 401k plan, deferrals are pre-tax, or like they're pre-tax, but unlike a 401k plan, there are no limits. Obviously, executives can't save the same amount due to the 401k limits, and the deferred compensation plan allows them to do that. The earnings obviously grow on a tax-deferred basis. And then the benefit payment flexibility, a non-qualified plan allows the executive to choose different savings options that wouldn't be available in a 401k plan. As an example, in-service accounts can be utilized if the executive wants to save for his children's college, or possibly to buy maybe a vacation home in the future, or a boat, or something like that. In addition, for their retirement, it allows them to sort of customize when they want the payments, how they want them, obviously within the regulations of non-qualified plans, but it allows them to match and more effectively manage their future retirement income needs. From an employer perspective, we think deferred comp is very popular. I'm going to talk a little bit more about the prevalence and the popularity in a minute, but obviously it enhances the employee benefit program for their executives. If the plan offers any type of vesting or a company match that has vesting tied to it, obviously that's a way for companies to retain key talent, and the flexibility they have in a non-qualified plan in terms of what they match, discretionary compensation, and other things are much broader than are what in our 401k. And obviously a properly designed program also gives plan sponsors a very cost-efficient result from that perspective. We'll talk more about that a little later. We'll go to the next page. I want to share Newport for the last several years, and will continue to. We conduct an executive benefit survey every 2 years that focuses on Fortune 1000 companies and some of the trends within their executive benefits, particularly in non-qualified plans. We recently conducted this in the last 30 days. We're in the process of compiling those results, and we'll be sharing them over the next, say, 60 to 90 days, and be available for you to use as a tool. But some of the trends that we saw with this survey, 92% of the companies we surveyed either offer or plan to offer a non-qualified deferred comp plan. And as you can imagine, some of the typical deferral sources, base salary, annual bonus incentive, and commission. Some of the trends we're seeing, and I'm sure being in the 401k business, you see this where a lot of the plans, the executives are limited due to discrimination testing and either limit what they can defer or they end up getting refunds. Certainly we saw that as 31% of the respondents said that was an issue. A non-qualified plan is certainly a way to solve that for the executives. Another trend that might not always be thought of is either signing bonuses or stay bonuses given to executives. They can defer some of that rather than take it all up front for tax planning purposes. It allows them to defer some of that money to the future for whatever need they might want, either, as we said, into an in-service account or for helping for the retirement planning, as well as we're seeing many companies that are offering long-term incentive plans and the ability to defer rather than take that income in a specific year. So that gives, once again, the executives some flexibility. Obviously, based on this information and ours, we believe that deferred compensation plans are very popular. Now let's talk about why we believe Newport is the best solution for you and your clients. On page 9, shared some stats that, as Micah said, Newport is the recognized industry leader in the non-qualified retirement plan space. And, as evidenced by some of our stats here. As you can see, we have over 450 institutional clients, over 85,000 executives in those plans. As Micah mentioned, we bring expertise and knowledge, both breadth and depth of resources and expertise. We have over 350 people at Newport that are dedicated to servicing and administering non-qualified plans. And a stat here that many of you probably very familiar with Plan Sponsors DC record keeping survey. We were ranked #1 in terms of non-qualified assets with over $23 billion under administration. So to get into a little more specifics on this, I'm going to turn it over to Mike Shannon, who is Senior Vice President of our non-qualified plan consulting team. He's going to discuss some of the product, services offered, and some more details on the pricing as well. Mike?
Yep, thanks, Jeff. Yeah, as Jeff mentioned, Micah mentioned, I head up our non-qualified consulting group, so all of Newport's non-qualified plan opportunities run through my team, and we'll talk a little bit later about how we'll interact with you and the qualified regional director on Micah's team for any new opportunities. But what I want to do here for a couple minutes is, first of all, just talk about what a non-qual, what a typical plan might look like, what the plan profile would be, and then we're going to spend a few minutes talking about what a standard plan design might look like. So something that fits within this bundled retirement solution. So this next slide talks about a plan profile. So what are you looking for relative to a new opportunity? First of all, it could be either a new or existing non-qualified plan, so it doesn't have to be new necessarily. There might be something out there already that somebody else is administering, and we've had great success over the years taking over plans from current administrators. Or it could be a new plan, and they want to implement a new plan. And the nice thing about Newport Group is that we have draft plan documents that we can provide for those new plan participants. Of course, the second point there is that it needs to be bundled with a Newport Group 401k plan. So again, that can be an existing Newport Group plan that's administered on Newport's platform, or it can be a new one that you're working on. The target market, so if you think about what the target market for this group might be, and we kind of identified as less than 50 participants, and let me give you some perspective of that. That usually translates to a company of, say, 10 times that. So it might be 500 employees, might be the total employee population, anything below that. Once it starts to get above that size, you might start to run into some plan design complexities that warrant our full, our full standalone non-qual. But certainly we would entertain plans that are bigger than that, but typically it's going to be less than 50 eligible participants. We'll talk about what that participant population looks like. And then the last bullet is a standard plan design. So it's something, even though there's a lot of flexibility in non-qual, there's a lot of flexibility actually in the standard plan design, it does fit within some parameters relative to ongoing administration. So that's the plan profile. The next couple slides, we talk about what a standard plan design might look like. And there's two fundamental account structure types. One is what we call a bucket design, and the other is a class year design. And so our systems are perfectly capable of handling either. And what you'll find out, or what you already may know, is that there are some administrators that do much better on a class year design. They're not able to handle the bucket design. And I'll spend a minute just talking about what that is. The bucket design, if you think about it, really is at the outset, or every time you make a deferral, you identify where you want your money, what bucket you want it to go in, and when you want it distributed out. So I might have a retirement account, and I can have a couple state-specific accounts where I'm going to continuously put money into those buckets. Class year design is just what it sounds like. Every year it's its own individual account. It gets a little more complicated as you start to add class year accounts and you've been in the plan for 5 or 7 years, but we can do either and they work perfectly on our platform. The eligibility, again, non-qual requires that it be a select group of management or highly compensated employees, and usually that's identified in the market as 10% of the population or less. You can go a little bit higher sometimes, but you really don't want to push it more than 10% of the total employee population. And they need to be paid in US dollars so that they follow under Internal Revenue Code compensation. The next slide, we talk about plan financing and the participant menu. So plan financing is, again, as you may know, is a non-qualified plan isn't required to be funded, but what we see is most of the plans, certainly the variable rate plans, the plans that are crediting a daily return tied to the market, those almost always are funded. I'd probably say 98% of our plans that are variable are funded. Some of the ones that aren't funded might be a fixed rate where they say we're going to credit something tied to company's cost of borrowing or some fixed rate. Sometimes those aren't funded, but probably 2/3 of those are funded. And yet, so when they are funded, there's two fundamental choices. One is mutual funds that everybody's familiar with, and the other one is corporate-owned life insurance, which is essentially provides some tax management of the assets, and we'll talk about that. The menu, and this is where you're already working with the plan sponsor on the 401k menu, and so usually what we would see is a 401k mirror. So the non-qual menu would probably be exactly what the 401k menu looks like. There is an option if it's fully funded and you have a different investment universe. We may have an investment menu that is based off of the COLI platform, and we have investment analysts on our team that would work with you to develop that if it went down the COLI route. All right, the next slide talks about actually deferrals and contributions. What does a standard plan design look like in the way of deferrals and contributions? Any type of cash compensation is eligible for non-qual deferral. So whether it be base salary, commission, bonus, all of those, and as Jeff mentioned, there really is no limit. So in theory, participants can defer as much as up to 100% of their salary or 100% of their commissions, 100% of their bonus. Usually there's something held back for payroll taxes, but there is no limit on the amount that they can defer into the plan. And then also, again, non-qual, because it's you can discriminate against different employee groups or in favor of. You can have matching contributions for this group or even discretionary contributions that that go into their accounts, and those can be used for things like retention or signing bonuses or stay bonuses, whatever they might be. And if there are employee contributions, the standard plan design would have a plan level schedule as opposed to, say, individual. So if I had 10 participants, we typically wouldn't want to see is 10 different vesting schedules. That starts to get outside the standard plan design. And then either cliff or graded vested, so typically a 3 to 5 year vesting schedule. All right. Next, this is where, for those that aren't as familiar with non-qual, benefit distributions, this is really where non-qualified plans have a lot of flexibility, different from your 401k, in that you can have a specified date account. You can say that I need my money out in 2022 because my child is going to college and I wanted to save some money for that. So you can have specified date account, benefits come out, separation of service, and then of course death or disability. So there's flexible, as I mentioned earlier, the 5 accounts can be 5 different specified date accounts. That all still falls under the standard plan design. And then they can be paid out in either lump sum or annual installments or combination. You can take a partially, our systems allow participants to elect 50% of their account paid in a lump sum and the remainder in installments or anything, any combination of lump sum and installments. Alrighty, and the next slide is actually pricing. So this is where it might be a little bit different than the qualified plan, in that we don't have a la carte pricing, we don't have per head pricing here. We have one flat fee and no per head fees, no per transaction fees. There's a $7,500 annual admin fee, and there's a $2,500 implementation fee. And Jeff's going to talk a little bit more about what's covered under the administrative, the annual admin fees, what services Newport provides. Under implementation, again, I mentioned things like plan documents, working on the funding strategy, working on the investment menu with you. Those are all covered under that implementation fee structure. So that's the standard plan design, that's the pricing. I will turn it back over to Jeff, let him walk through some of the administrative features relative to Newport's non-qual services. Jeff?
Thanks, Mike. All right, so if we start on the next page, I'd like to talk a little bit about, in more detail, kind of why we believe Newport is the best solution for this bundled offering to help you grow your business and to ensure you have high retention of your clients and highly satisfied clients. So I'm going to share a little bit about that. Some of our key differentiators. We have over 30 years of experience in the retirement plan industry, as well as working with advisors like you. Your client's dedicated team includes people who focus on qualified plans, as well as those who focus on the needs of non-qualified plans. You remember earlier we talked about the 350 people that focus on that. Those come from disciplines such as consulting, legal, accounting, and client service resources, who are all focused on the non-qualified plan business. That focus allows us to ensure their plans are 409A compliant and meet or exceed the needs of their executives in the plan. We also are a technology leader. We provide tools that help the executive with managing, as an example, the cash flow from the deferrals they've made, and can see sort of when those will pay out, help to understand what they've deferred so far, and can help with retirement planning and many other tools, and have been recognized by many industry resources as a best-in-class from a technology perspective. We also offer tools from a community. Obviously, these plans, often one of the key things that's critical is ensuring that employees know about the plan, they know about the benefits, and they also know what any restrictions. So communication, education is critical. We offer many tools to you that can help you educate the executives on our non-qualified plans. We have a very robust suite of those types of tools that can help in that process. Mike talked some about our consulting resources, and obviously Mike's team are available to help with that, as well as the onboarding of the plan. We have a dedicated resource to ensure that the plan is properly set up and implemented on our platforms timely and within the client's needs. If we'll turn to the next page, we'll see a little more detail on our non-qualified plan administration. And kind of starting on the left, thinking about, and one of the terms we use is total plan management, and what we mean by that is really bringing all the resources necessary to effectively onboard, administer a non-qualified plan. So starting with, obviously, the implementation and onboarding of the plan, from helping with the plan design, both with existing cases where we may take a look to say, is the plan contemporary, or are there things we could do to enhance the plan to make it more efficient, understanding the client and your objectives with the plan, as well as the implementation and onboarding of it onto our systems by a project manager. We have obviously a full suite of record-keeping services that are fully integrated and 409A compliant. We offer both plan sponsor support through a relationship manager, as well as participant support through a call center that is trained and equipped to handle non-qualified participants as well as qualified participants. Accounting and financial services, certainly non-qualified plans, the funding and those things, as Mike mentioned, are a little different. So we offer full asset and liability management, because these are obviously notional accounts at the participant level. The asset sits on the corporate balance sheet. So we offer services to ensure those are in alignment on a daily basis. We also provide a suite of accounting and reporting services to help the client with any of the reporting needs, their accounting team. And last, we mentioned some of the tools from an online access, but have a full document forms library, modeling tools I mentioned before, gap analysis, and then all of our website is fully enabled on both smartphones as well as tablets, and as well as just standard desktop. So if we turn to page 20, obviously those suite of services, we believe are best in class and been recognized, and many of you are probably very familiar with Plan Sponsors Defined Contribution Survey. We're pleased that the last survey we received 52 best in class honors, one of only 2 providers that received more than 50. We also had the #1 overall net recommendation score in the $50 to $200 million segment. So we're very proud of that. Work very hard to focus and continue to meet clients' needs, as well as the needs of the advisors that we work with. On the next page, on page 21, what we've provided is some questions that can maybe help determine, help you in the selling process. So, asking a simple question, does your company have a non-qualified deferred comp plan, is usually a great starter, obviously. If the answer is no, trying to understand why they've had it, have they had one. Often people believe they're complex. Some small companies have administered them in-house with little knowledge, and it hasn't worked for them. So understanding where they're at and what the needs might be. So obviously, yes, and one of the things that we do is, if the company has a plan, we can take a look at it and determine, as I said before, are they using best practices? Are there things we would recommend? And certainly working with you of how we can both improve the plan and some of the challenges and questions around, are there limits on highly comped and others? So it's just some tools that maybe can help you with uncovering opportunities and help grow your business. With that, Micah, I'd like to turn it back over to you, and we can field any questions that may have come up.
Great. Thanks, Jeff, and thanks, Mike. Covered a lot of ground in about 30 minutes here. Before we get into the questions, you'll see on the map here, this is our qualified plan sales team throughout the country that will be supporting advisors on bundled solutions, both the qualified, obviously, but then also the non-qualified where it's bundled under standard plan design with the qualified plan. And so you'll hear more from this team as the future goes on here, but a great group of people that are well briefed in this offering and will be able to support you in your business. We've got actually a fair amount of questions, and I've been reading through the questions. Great questions from the audience, so I'd like to throw these back out to Mike and Jeff to be able to address here. And we'll just start at the top here. Let's see. The first question is, does your interactive participant site for a combined 401k and non-qualified solution integrate seamlessly with a single login?
I'll take that, Micah, and then we want to fill in. But the answer is yes. We'll have a fully integrated where, and some of this is obviously the platform consolidation we're currently going through. But the participant will see one location, not through a single sign-on, but a fully integrated both their qualified plan as well as their non-qualified plan.
Great. Yeah, and that's, I get that question a lot out in the field with our sales team. And we're actually one of the few providers out there that truly does provide that single access. And I think there's some really nice benefit of making it simple and easy for your clients and ultimately the key executives to see across the spectrum of their tax codes. All right, so the next question is, what is the turnaround time for an initial implementation process for a bundled non-qualified plan?
Micah, this is Jeff again. What we typically see is our standard implementation is anywhere from 90 to 120 days from when the client decides they want to do it. Obviously, that can vary depending on the client needs, depend on if they've done some of the upfront document work and other things. So, typically it's at minimum 90 days because there's a lot of work, especially if it's a new plan and we need to review documents and other things. But that's the typical timeline we work with. Sometimes there are clients will extend that. It's really based on their internal resources and the commitment on their side as well.
All right, great. Who typically pays the annual administration of and the implementation fee on a non-qual plan?
I'll take that as well, Micah. The company typically pays that. We bill them quarterly, and they pay that. Occasionally, I think we've had a desire to charge that back to participants. I think there is the ability to do that, but typically it's the plan sponsor who's paying those.
All right, and next question is from David Hilton about does Newport Group help with the COLI placement?
I'll take that. This is Mike. Yeah, we have a team of actuaries and financial analysts that work with, and you actually have a consultant on my team that will be assigned to the opportunity, and they're your liaison to that financial services group. And so they will, through that team and also our new business underwriting team, they'll handle all that placement. So 100% of it's handled by us, with your participation and, in the product and the investment menu, but there's really nothing other than being licensed. There's nothing that you or your team needs to do.
Great. All right, next question from Jonathan. Are execs actually deferring a portion of their current comp in most non-qualified plans, or does the contribution usually represent additional comp above and beyond current pay from their employer?
So Mike, you can take that, or I can.
Yeah, I mean, I can take it. If I understand the question correctly, there's two concepts. One is if I'm making $200,000 a year and I want to defer a portion of my base salary, I can do that. Or if I have a bonus that might be $100,000 a year, I can say, you know what, I'd like to make sure that I get a certain dollar amount in before I defer anything, and so I might defer a percentage over and above something that I need to live off of. But salary is usually a percentage of current compensation. Bonus can be a percentage of future bonus, or it can be a percentage of some number over and above a dollar amount. If that's the question, but typically, and those I don't think we mentioned, but those are all determined, as you know, an election needs to be made annually in the calendar year prior to the year it being earned. So that election's taken usually in the October-November timeframe during a fall enrollment.
Great, thanks, Mike. All right, next question from Jason is how do split dollar plans relate?
How do split dollar plans relate to a deferred? Those are typically separate plans, and always funded with life insurance. There are plans that, because life insurance is often used in non-qualified plan operations, you have the ability, because you can basically have the policy do double duty and have a split dollar plan as well as a deferred compensation plan, or you can have what's called a death benefit only benefit, where it's similar to split dollar without the imputed income, and you offer a portion of the COLI proceeds on a pre-retirement basis to the participants that's in the deferral plan. So they can be either standalone. We do that. We do split dollar plans as well as deferred comp. There's not a whole lot of split dollar plans built in with where it's, I said, double duty. Except for the death benefit only, or the DBO approach. So again, my team has seen, they've all been in the industry for 15, 20 years, and so they've seen every plan design and certainly could work with you on anything that you come across.
Great, thanks, Mike. All right, so the next question from Stephen, who are the custodians where the plan assets are actually being held?
So I can take that. The custodian can be the same as who handles the 401k side. So often it's the same one. We work with multiple trustees where a rabbi trust is set up for the non-qualified plan assets, so that can be that. We have recommended solutions and partners that specialize in the non-qualified plan business that we work with. And a future offering that we're in the process of working on rolling out is Newport Trust. We'll also, as many of you know, we serve as trustee and custodian of assets in 401k plans. We'll be doing the same for non-qualified plans, sometime this year. So we're in the process of working through that, setting that up as well.
Great. All right, thanks, Jeff. All right, the last question that we got actually has two parts. First part is, what do employers do when they sell their firm for the non-qualified deferred comp arrangement, so those executives aren't forced to take distributions immediately on the sale? Let's handle that first, and then we'll go on to the second part of it.
Yeah, that's a great question, and it starts to get into some complexity around acquisitions and mergers, et So if there's a stock sale of a company, I mean, the plan can continue if the acquiring company is buying the assets of the company and or buying the stock of the company. The plan can continue as is, and there isn't a separation of service. There isn't a payout event necessarily. There's a change of control, but a lot of our plans, most of our plans have what we call a double trigger, meaning that if there's a change of control, that isn't necessarily a payout event. There needs to be also a second trigger, which is a separation of service. And so you can have, as most companies throughout their evolution have changes of controls, that isn't necessarily a triggering event or a payout event. So oftentimes the plan will continue with the new company, and participants will just stay in the plan and continue to be able to defer. Some companies will freeze the plan and just they may have their own plan, and so participants may be eligible for that. And then there's certainly situations where the plan is terminated upon a change of control or a sale or something, and that is allowable under the Internal Revenue Code as a distribution event. So people are paid out. So it varies depending on the situation. And the nice thing about Newport is that we have internal ERISA counsel that can help navigate with the plan sponsor through any type of situation relative to mergers or acquisitions.
And then the second part of Mark's question is a good question, and for those who aren't insurance licensed in their state and don't sell COLI, how does Newport Group facilitate the transaction so that we can operate in a fee-only capacity? Why don't I take that, and then Mike and Jeff jump in and add on anything additional. So we've had this conversation actually both on the mirrored lineup and the COLI side fairly often internally here as we've been developing the solution. And so in a mirrored lineup, and I think that's what you're alluding to here, Mark, is when you're not selling insurance, you're operating as an RIA fee-only environment, and so you're funding the non-qual solution with mutual funds. How do you typically support that fee-only basis? And so largely we would promote an institutional mutual fund lineup with very little to no 12b1 revenue sharing, driving the cost as low as possible. And depending on that, what that fee agreement looks like between the RIA and the client, which is typically direct, we would recommend and promote taking into account the complexity of the service work and the assets under administration as you build that fee-only component. We bill on behalf of the client, typically in a ERISA 401k plan that we would deduct from plan assets or participant assets. This is different, and so we would probably recommend that you take that into account when you're building that fee only and assume the non-qualified solution when you quote your fee to be inclusive of both the qualified and non-qualified. Jeff and Mike, anything to add to that?
No, I think you said it very well.
Great. All right. Unless looking through here, the question, I think we did hit all the questions, and we are right at about time. So again, thank you all sincerely for your time and attention today. We're really excited about being able to offer a bundled non-qualified solution for the marketplace. We think it's going to help open up a tremendous amount of doors for advisors that we're currently working with, and then in an effort to grow our distribution effort as well. Again, as we started this conversation, we're committed on a quarterly basis to bring thought leadership through Newport Group to advisors throughout the country. And so look very shortly, not only for the survey that we always look to see how we can improve these, so please take a few minutes and fill out the survey that will be immediately following this. Next week, the presentation is going to be sent out to everyone who is dialed into this call. And we'll also be able to provide more information on the next quarterly series. Thank you again for your time and attention, and we look forward to working with you in the near future. Have a great day and a great weekend, everyone.